Morning, everyone. Sorry for the delay, as we were dealing with some technical issues to make sure our camera and audio, everything works. But I'd like to welcome you all, wherever you are in South Africa, whether it's Joburg, Cape Town, Durban, wherever you are online, on our YouTube, Facebook, and LinkedIn platforms. And wherever you're in the world, welcome. And again, this Friday is a bit cold, but not as cold as last Friday when I did another session. And today, I'd like to welcome Gustav Schulenburg into my studio. And thank you for joining me as we talk about PSG and about investment and where you see the current landscape. So I just like to do a quick introduction of Gustav. Gustav is a co-fund manager of the PSG Asset Equity and Equity Fund. He joined PSG Asset Management in 2016 and was appointed co-fund manager in 2018. He performs research on local and global companies across multiple sectors. Prior to PSG, Gustav was part of the Global Emerging Markets team at the Old Mutual Investment Group, and he previously worked as analyst and a trainee portfolio manager with Electus Fund Managers. Gustav, welcome to our session here.
Thanks a lot. Thank you for having me, Kevin.
How are you doing today?
I'm good. Trying to keep warm, but it's Friday, and it's nice to spend a bit of time with you and your viewers.
Right. Okay. All right. So, Gustav, I'd like to maybe start with introducing PSG and PSG. I've worked with PSG Asset Management as an advisor, and I've known the key people at PSG for some years. And PSG has a good track record if you look at long term. Obviously, we will go into the more recent history. I think that without further ado, I will let you talk about PSG in terms of if you can give us a bit of a background about PSG Asset Management, its investment philosophy, etc.
Cool. Well, thank you. And once again, thank you for the time and engagement. Just to give you a bit of background around PSG Asset Management, the business formed out of the combination of two asset managers, which were Alphen Asset Management and PSG Tanzanite. So the two merged and formed PSG Asset Management is obviously owned by PSG the listed entity, which owns the PSG Insure and PSG Wealth and PSG Asset Management businesses. So that gives you a bit of background. If we move on to the slides, I think there's a summary, these facts, and it just gives the viewers a sense of how we are structured. Bringing together Alphen and Tanzanite into the entity. So if we go to the fund range or the product range, we can see at PSG we believe in a focused fund range, kind of more focused product along the risk spectrum. So your viewers can see there we have the market fund up the risk or duration spectrum with our Reg 28 funds until we get to the balance fund, which is our Regulation 28 fund, and then the PSG Flexible Fund, which many of you will know, further out to the longer duration funds, which you do SA Equity, PSG Equity, and then the global funds, which focuses on offshore investments, and those are obviously the feeder that go into those offshore funds. So we believe there's a broad range for all investors and their different risk appetites and for all advisors to find a solution for their clients based on the needs. So yes, we believe we cater for all these kind of risk appetites without getting into a situation where there's excessive complexity. So yes, if we then move on to our philosophy, which you mentioned.
Okay, Gustav. So my comment here is that PSG has a small fund range. It's got a pretty focused fund range. It's if I can see from the kind of maybe the philosophy here is not to try to offer quite a wide range of funds, but rather have a very a small range which is targeted at different risk profile and managed accordingly. So I would that's a comment I would put there. All right, so let's move on to the next one.
So in terms
of
so
here it talks about your investment philosophy.
Yes. So we just unpack this a little bit. What we do at PSG is we employ what we call a 3M philosophy, and the 3M philosophy means we incorporate the moat of the business with the management skill and track record, combined with a margin of safety. So we are very sensitive to the valuation, but we try to incorporate the qualitative factors of the business moat and the management track record in that, rather than focus purely on the quality or purely on the price. What is important here is to know that we investors, we are very patient, we are very much bottom up and very much benchmark agnostic. So we do not believe in investing clients' capital in a company simply because it's part of a momentum-driven benchmark. We believe in trying to find the best long-term opportunities for clients, do the work ourselves based on the bottom up rather than macro and cyclically driven factors, and build our performance, our funds on those metrics. We are we disregard the macro. We are aware. We think it's appropriate and prudent to be aware of what's going on, interest rates, GDP numbers, commodity prices, etc. But we don't make explicit forecasts on these and build our portfolios based on macro views. So it's important. It's a different type of product to many managers, but we believe it's the best way to outperform over the long term at appropriate time periods. So yes, that's what we try to do. Obviously, in terms of the 3M philosophy, there will be companies that deserve a different rating in our view because of the qualitative factors, and there are companies that deserve to trade at a discount. But this is all incorporated into the 3M philosophy, which is why that is the way we do it, and that is the way we're comfortable doing it for clients. So that gives you a if we move on to the next slide and we look at
Gustav.
Yes.
We need to pause on this one slide, okay? And I need to kind of maybe bring you down to the level of our audience, because you can imagine many of our viewers, they are not afraid with investment. So for me as an investment professional advisor, I understand what you talk about, but there's so much to unpack on this slide. So I just like you to just dwell on this for a while and then unpack this, okay? Because that if you can imagine like a young investors where they just start to learn about investment, and what you talk about here at a high level, it can be sounding quite good, but what does it mean in details? And I just want to unpack this. So first of all, I'm going to just show this. So because like when we talk about moat, okay, and I think that people, a lot of people out there, they talk about moat, they're not quite sure what this is about. So I just want to first bring this picture and to show everyone that watch this video and understand what moat is about. So if you look at the old times, the ancient times where they have a castle, or like fortification, and where they have kind of a water around the some kind of civil works to have water around the castle to protect the castle. That's what when we use the word moat. Okay, so it's kind of a protection and against your possible enemy that may be coming to attack you, and so you kind of have that the walls around your city, around your space, but also you have this water around the castle. Okay, so Gustav, can you just explain to us what does it mean by moat in the context of investment?
Yes, thanks for that, Kevin, and I like your picture. It's quite an apt kind of description. So when we look at moat, there are various forms of moat. So regulatory. If you take companies like MTN and Vodacom and Cell C, one can't just launch a new mobile network. You need a license. Banks, you need a banking license. So there's regulatory moats that protect them in some way. Then there's moats in terms of pricing power. So you would find that potential food retailers and some property companies and some staple companies globally that sell less discretionary products. So products like food, products like cases, things like cigarettes and beer and so on. Higher pricing power. That in itself is a moat because it is something which does not get as easily cut when times are tough from someone's budget. They have to go and buy the bread and the milk, but they don't have to buy a new T-shirt or a new car. So there's a moat in terms of how the company generates their revenue because it is a more essential product. That is a moat.
Right.
Then there's the companies that have a moat because they have a high margin means that obviously there's a lot of money left over after you've paid all your costs. Now, why is a moat is it means that if tough times come and your revenue comes down, it takes a longer time before you make a loss and you struggle to pay your interest and your staff and your shareholders. So that in itself is when you've got a higher margin leeway to tough times. So there's forms of moats, but as you described in your picture show, it's the business's ability to defend itself to cycles going against it, and it's the ability of us as investors to know what the business is able to generate, and also that it'll be around. One of the main things in successful investing is you need to invest in companies that are going to be around. Now, the stronger the moat, the more likely the company will be around. Does that make sense?
Yeah. Okay. So moat is something that where because of like you mentioned about regulation, or maybe because of essential item, or maybe the company has certain competitive advantage against its competitors. Maybe its product is superior to its competitor. Maybe it's possess certain technology that or create a better product than its competitor, and where it's difficult for its competitor to try to replicate. Is that what you consider a moat?
Yeah, 100%. You take how many people use Windows at the moment? It's a technological moat which is immensely strong. And has been for a few decades. So that's another example. Yes, it's intellectual property is definitely a moat if it's valuable.
All right. And Gustav, the second aim that you have here is the management. All right. Can you just unpack for us what PSG is looking for in management that would make you want to consider that company as an investment?
So management, yes, is crucially important. At the end of the day, in our view, as CEO's main responsibility is allocation of resources. And resources means allocating of capital, where you invest, where you cut costs, what you buy, other businesses, where you expand. Other resources that the CEO or managers have to allocate are people, where you put certain people, where you don't, what risks you take. And all of this is to add value or how you destroy value. So to have effectively, for the lack of a better word, to have a good jockey means that the business will more than likely make the right decisions on a day-to-day basis and not end up destroying capital, not overspend where it doesn't need to, not underspend where it doesn't need to, and make good long-term decisions for the sustainability of the business. And what you find is that when you have good management that make good decisions, that by definition increases the market because they transform the business slowly into a stronger business. Then you have a stronger business which is more sustainable for the long term, which means that you attract better management because they want to be part of and lead a business that is a lot stronger. So it becomes a self-fulfilling prophecy, and unfortunately on the way down it does too. Value gets destroyed, the moat is often reduced, and that then leads to you losing good people. I'm sure your viewers will all be kind of aware of that in their lives, and management is critical and the sustainability of it.
And let's talk about the third aim, margin of safety. How do you what is margin of safety? You talk about price. I've read books about Warren Buffett and Benjamin Graham about margin of safety. But can you unpack for the viewers what does it mean by margin of safety here?
So margin of safety is just, none of us know what the future holds. I don't know with certain. So margin of safety is to ensure asymmetry or odds in the price you pay. So you know, we're paying for an asset, even if it's a very good, high quality asset. So in terms of margin of safety, one has to, if you want to successfully invest, one has to buy an asset at some point when it's cheaper than its intrinsic value. Now, the more discount one can have to that intrinsic value in terms of the price you pay, the bigger your margin of safety. So if we break it down to everyday life, if there's a house or an apartment that is worth R1 million, you pay R1 million for it, and you need the asset value to grow for you to sell it at a profit. If that apartment is worth R1 million, but you're able to immediately, you're going to not necessarily lose money. So the margin of safety is critical to the way we invest. Is of the using the model.
Hi, Gustav. I seem to lose you here. It looks like maybe your connection, your internet connection is dropping. So just to let you know. Oh, unfortunately, I lost Gustav. So I hope that he will rejoin. Let's see what happens later. But in terms of a margin of safety, okay, that's he's rejoining, and I hope that this time is going to. Hi, Gustav. I don't know what happened. It seems like you fell off. But right now you rejoined, and I can see your connection is now good. So yes, just now we're talking about the margin of safety. Can you just continue with that discussion?
Yes, apologies. I don't know where we lost each other. The margin of safety is effectively the safety buffer. You have to the price that you think the asset is worth versus where the market is willing to sell that to you. So in times of lots of stress and panic, often the market puts very low prices on assets that are worth a lot more, and that effectively is your margin of safety. I'm not sure whether you caught. I used the example of a house or apartment that you buy, and you pay a lot less for it.
We did talk about it. Okay, yeah.
Yes,
so Gustav, here is about the margin of safety. Essentially, you want to buy something at a lower price. Okay, so if I look at your investment philosophy here, the first two talking about the quality. You want to invest in quality company, but then the last factor, you actually want to buy the quality company at a reasonable price or a attractive price. So that's where the margin of safety is. You don't want to pay the full price or exorbitant price for something, even though it's a good thing. So I think that's how I would sum it up in terms of the margin of safety. I think that's where the expertise of investment professionals come in, because that just now you talked about the intrinsic value. Yes, we can look at all these share price of the listed companies, but that's a market value. That's a share price. That's a current market value, but it doesn't mean what's its intrinsic value. And that's where the investment professionals will look at the various factors and make assumptions about the future, and try to ascertain the intrinsic value of a company. So I think that's where the investment expertise and the ability to make certain assessment quantitatively and qualitatively is very important.
Well, we try.
Yeah. All right. Okay. So Gustav, I'm willing to let you move on now. So shall we move on to the next slide?
Touch on this. We've covered some of it, but on the next slide, it's just how our process. We are bottom up and benchmark agnostic. As I explained, there's a fundamental research that is done on the companies. Then the way we structured is we've got two investment committees. There's an equity investment committee and a fixed income committee. These two committees kind of assess all the options. Every fund that we showed earlier on the risk spectrum is either by regulatory compliance allowed to invest in certain assets and not in others, or based on the asymmetry, which means the risk versus reward trade-off of each asset in the funds that can invest in multi-assets, and that the and the portfolio from the buy lists that are constructed by the investment committee portfolio. So it's a key message on this is a very based approach. It's a very fundamental approach, and it's a very broad approach where the same equity and fixed income investment committees will look at the global stocks, they will look at the local stocks, they will look at the property stocks. It's a very broad way of looking at things, and all different assets are considered based on risks on a bottom-up basis. So it gives you a sense of the process. It's very layered, but very based.
Right. And Gustav, just for viewers' benefits, your role as a co-fund manager, does that mean that you get all the kind of feedback or reports, analysis from the analysts and the investment committee and that? Then at the end of the day, do you then go out and then you decide which stocks you're going to buy? And then because you are a co-fund manager, do you and your co-fund manager you agree and have consensus to buy certain stocks and a certain weighting or in a portfolio, or does each fund manager do their thing? Do their thing. So you may decide on certain shares you want to buy and a certain weighting, but then the other fund manager will then do his own thing. Is that then together you put together, then that would be the end result for the investor?
So no, yeah, I mean, prices change daily and there's a lot of rigorous debate, but
yeah,
the main thing, and there's no right or wrong. Other houses may do it differently. The way we do it is it's very team-based approach. So once the research is done by the analyst, it's presented to the investment committee, whether that be fixed income. There's a debate. There's often different discussions, different questions. These are quite rigorous and intense debates. But then we will discuss the stock on its merits based on the analyst and the work that the analysis. And then typically what happens is there's a vote. The investment committee will discuss it at length and then vote whether it should be added to our buy lists or not, and at what weight in terms of the recommendation. But then the ultimate decision is with our managers whether they implement and at what sort of funds that are co-managed. Because we all work off the same buy list and share an investment philosophy, when it gets to that point, the debates, we don't go off and do our own thing. We'll discuss it and we'll come to a conclusion that's for clients, but we don't invest separately and then put it together like some others do, just because that's not part of it. We discuss it and then use the same buy list.
I see. Okay. No, thank you. All right. Then shall we talk about risks and opportunities where PSG is seeing the landscape at the moment? And the other thing is that I think that for inexperienced investors, all they look for is returns and rewards, but they didn't consider risks. I think for me, with the benefit of having 25 years of learning and experience, I learned to appreciate that when it comes to investment, we need to first appreciate the risks before we can even talk about returns. So here we go. So Gustav.
Yes, I think that's a very valuable point, Kevin. We think our investors and participants in the market risks and assuming that the next decade could look very similar decade. And what we're saying is, if you look at that picture, typically it's the same place, but in the different seasons, you certainly need different outfits and different activities in the same place. And we're saying, what if tomorrow looks very different? One needs to be open-minded. There are a few things could have changed structurally. A big risk for them is assuming the last decade, the next decade. We think there's kind of red flags coming up if we're not at an inflection or and on the net is over a 50-year period. There's a broad correlation between the US 10-year bond yields and now last 40 years, it's broadly, obviously there's been, but it's broadly been a downtrend in inflation and in the cost of capital, the risk-free rate. What we've been expecting for a while is and that's led to a couple of dynamics in our, which we'll a bit later. But what we're betting is that it cannot continue forever at this trend. And what we've seen post-COVID is that inflation in countries like the US really surprised on the upside, and that has arguably been made worse by the Russian invasion of Ukraine. But we don't that is the sole reason. There's a few other reasons, and one is the starting point. It's just for 40 years it's gone down. At some point, it could change. Now, last decade has been the most extreme in terms of this deflationary or almost zero inflation, zero interest rates environment. And we would caution investors' perspective to be very careful to assume that inflation and zero interest rates are going to be at the order of the day for the next decade or two. And is exactly where we're finding the opportunity. So this chart will show you that orange line is inflation in the US, and we can see how strongly it's come up. Now, should the 10-year match that, or close to match that, it could reduce the capital cost.
Okay.
So,
I think
yes,
I think that
the changing
Gustav, looking at this.
Yes.
Okay. Just a comment from my side. I think that recently I read a book by John Bogle, who is the founder of Vanguard and the pioneer of index investing. And in his book, he reminds me about the concept of reversion to the mean. So we should never say that it's the new normal and it's different this time. But rather, like reversion to the mean in terms of inflation and interest rates. It could take very long time to play out, but eventually you can't. The low interest rate, low inflation environment certainly is not sustainable for a very period of time.
Yeah. No. The thing is, we're more referring to cycles. And we're not necessarily saying it's different this time. We're just saying that we think this cycle is coming to an end, and it's just be careful to assume that it will continue.
Yeah. Okay.
So if we then say, what if these red flags that are going up in terms of interest rates and inflation are sustainable? And what if this is part of the cycle, but the next 10 to 15 years sees higher rates and higher inflation? Then what will be different in terms of how one invests? So the last decade, because inflation was low, long duration assets were very much in favor, because inflation does not eat up your capital if you invested for a long time. You could wait a long time for your returns because inflation's not high in the time. Capital was cheap, so there was lots of acquisition. Capital-like businesses were at a premium. The US dollar was seen as a safe haven. So this is the environment that you would find yourself in the last decade, where assets are bid up, the tech assets that are long duration, that'll make money one day, your consumer staples that kind of high multiples, and you could wait at 25p, you can wait 25 years to get your money back. So this environment you're in, when debt is cheap and inflation is low. If we look back to the previous period that was similar to a high inflationary period, what worked? It was not that. If bond yields rise, inflation rises, and interest rates rise, investors are incentivized to get their cash sooner, because the longer they have to wait, the more inflation will eat up their capital. So typically, high dividend yielding stocks, high free cash flow stocks, your typical emerging market and value stocks, and historically your materials and energy, because of the nature of the companies, are then much more in favor, because they historically have been better inflation hedges, making the point that if the cycle is turning into a different part of a cycle, then be careful to assume that the assets that were popular and the best performing assets in the past will be the best performing assets in the next 10 years. We think there's risk to that, and it brings opportunities in other parts of the market.
Okay, so right now you see that going forward, the real assets, like the ones you listed here, are likely to do better. I think it's a scary period we're going through, because that if you look at the inflation around the world, is is ticking up, and even in South Africa, last time the inflation rate is now 6.5%, and who knows, it could even go up more. So this kind of inflationary environment where people are finding that the cost of living is higher, fuel and even food, etc. I think it's it's about how to survive for a lot of people, and then for investors, how to invest and to actually protect your money, so you are not going to the real purchasing power of money is maintained instead of being reduced over time. I think that's really important.
Yes, and I agree. Important message to clients is to be open-minded and pragmatic about this. Look at the facts and not just find comfort in what has worked. That's the first thing.
Yeah.
The second thing is to take a long-term view. So many companies listing and being built up, and the Bitcoins and the Robinhood, that those could be passed. We don't know forecasts, but there's certainly signs of that.
Yeah. Gustav, it's interesting you mentioned about cryptocurrency, because last 2 years since COVID started, and the way that the cryptocurrency like your Bitcoin, Ethereum has been doing the run, and many investors they made money earlier on, and people were talking about the cryptocurrencies like inflation hedge, and also like it's a protection against like the central banks printing more money. But now if you look at how the crypto has been performing this year, then essentially it's now people are starting to say it's like a risky asset, and it's very risky compared to the stock market, because now like essentially it's like a leverage instrument. When the market went up, then it went up like 10 times. When the market goes down, it goes down by 10 times. So suddenly, then the argument of cryptocurrency being the inflation hedge doesn't hold anymore. So yeah, I think it's still for investors and to really to see how this crypto space plays out over the next few years.
Yeah. No, I agree. It seems to trade more like speculative tech stocks than
Right. So
this line speaks to the same argument, and the message is just how stretched things are. So this is your long duration versus short duration assets, and effectively long duration assets are just assets that are more correlated to the kind of risk-free or perceived risk-free 10-year bonds in the US. So it's your assets where effectively you're taking a view that in over the long term you will make your money back. The duration assets are assets that give you your money shorter duration. So high dividend yields, current high free cash flow yields, and then your real assets, your properties, your commodities, materials, etc. So the you see is how wide that gap is now, and we don't think necessarily tenable, and that's exactly where we find risk and opportunity. Risk on the top line and opportunities at the bottom line, and your shorter duration kind of real assets rather than the top line, which is your long duration financial assets.
So Gustav, if I look at your explanation in this chart here, can I interpret as saying that probably PSG right now avoids all these giant tech giants like Microsoft, Amazon, etc., and maybe you'll concentrate on kind of the stocks where maybe the PE ratio is much lower?
So yes, that has been the case for a while. It's not because we prefer those or have anything against tech stocks. We were big holders of Microsoft, Apple, and Qualcomm, and these types of companies for a long time. We unfortunately sold them too early a few years back, and we believe that they they got to levels that are obviously priced. Obviously, they've come back a lot, so they are becoming more attractive. But right now, we don't own any of those on behalf of clients, and but we're not averse to them. If we believe the price is there, the margin of safety is there, we will buy them. Right now, though, we are finding better opportunities in your box with a low B and a higher dividend yield. Not necessarily deep value stocks. Decent quality companies, but companies that are just, in our view, mispriced, and where there's a lot of cash profits coming out, which is the key factor for us, is the cash profits and what.
Right. Okay.
This explains to us a bit about why we find ourselves in this situation and what drives these kind of market experiences. So if we're looking at mining capex, it's very interesting to look at it relative to where we've been in the past. This is at an all-time low relative to their sales. So the miners in capex. So the argument is that the supply side is being constrained. There's supply coming on. And we think the market underestimates the demand that could come from the normal, for lack of a better word, old school economy, as well as electric vehicles and renewable energy, as well as consumption from emerging markets like China, in a post-COVID world, and no new supply is coming online. So then the release valve has to be the price going up. And we've seen some of that. We would argue that we haven't seen the end of it. We don't know where things go in the short term, but what we do see is mines are not investing in capex. They're not investing in new mines and extra supply, and we don't see the demand going away. We actually see the demand increase. So this provides a situation where prices could be a lot higher. So we've nice opportunities in some mines. We've shown some there on the right for various reasons, but the overarching comment is that in commodities, materials, we see the same in energy. There's been a lack of investment now by requirements to comply with ESG kind of expectations, as well as the inability to source funding. So this is creating a supply constraint, which typically leads to high prices.
Gustav, I have a couple of questions here, or maybe comments. Number one is that Thungela. This is a very interesting stock because last year I think it was listed at 20 Rand. Now it's over 200 Rand. So it's a 10-bagger in investment speak. So at such a high price, do you still see value in Thungela or the prospects for Thungela? Then my second question is that if I look at many of these South African-based, more South African-based companies, we have problem with the load shedding, electricity supply, and perennial labor issues. I think recently there's a long strike at one of the mining companies, and also with ArcelorMittal and metal workers industry, etc. So that's quite disruptive to the operations of a company. And don't you? I'm sure you also understand all these risk factors. But then, do you still see them attractive, taking into account all these issues?
Yeah, so I suppose that's part of our job. You don't typically find good quality assets and cheap prices when everything's going well. One has to look through the cycle and through the kind of short-term noise. So often when these things happen, like all disruptions, that gives an opportunity to buy the assets but at a lower price, because people that are more short-term focused would sell the stock based on bad news that is not necessarily permanent. So we try to long-term view, and assess the structural change. And if there's no structural change, but we can buy the same assets at a much lower price, we really like the assets, then more. In terms of Gela, it is very interesting. Anglo American were encouraged to spin off assets to be more ESG compliant, and decided to spin out Gela, and investors who held on or bought more have done very well. And the irony of it is it's pure coal miner and coal in ESG investing right now. So we don't make a call on ESG. It's not. It's investment. It's a very hot topic and very sensitive topic right now. What we do is we look at a company like Thungela and we see a supply constraint in the coal space, and we see a miner that is priced at a very, very cheap valuation. I mean, it's gone up 10 and it's still below a 5 PE. Coal prices that to
Hi, Gustav. Are you still there? Sorry, it seems to you seem to have frozen. Okay. Let's take a break. I'm just waiting for Gustav to come back to the session. I think maybe it's again a connection issue there.
In many of the developing countries, and so on. There's, in terms of social impact, we think often the three, the E, S, and G, are not weighted equally, and we try to look at companies, and also what's important to understand is these companies that are apparently ESG contributors. It's easier to influence and assist them to become ESG citizens whilst being owners of the company, rather than being non-owners and just sitting on the So a company like Thungela, we're comfortable owning. We think it's done well. It has done well for clients. We think it could continue to do well for clients. And we just try to stay balanced and pragmatic on it.
Okay. No, I think the topic about of ESG is certainly very big and very topical at the moment. But I think that investors are considering what it means by ESG, or reconsidering, because I think that to make it very narrow focused and then say that certain mining activities or products are bad and certain things are good. Certainly, I think it's it fit into a very narrow frame of thinking, at least in my view. Whereas, certainly it's not practical for a lot of African countries to say, now just switch to solar and stop all the mining. And whereas it's still required and needed, So even though that mining activity can damage the environment and that, but if you look at the world today, and then people are using or having the electric cars or the phones, computers, etc. You need to mine the materials which can then be used to produce these products. So I think at times that I'm not quite sure about some ESG proponents in terms of their focus, whether they actually have thought through all the consequences of their strategy or the philosophy. But I think that's a topic for another day.
On the next slide, I won't delve into, but it speaks to the same point. Just energy investment bias is at the 97th percentile. So there's no investment going into energy, and we
Yeah.
You can see at the moment what's going on with energy because of the lack of supply.
Yeah.
So we finding great opportunities in these as well. So I think, if we then move on to the next slide, this just as important is differentiation has become a necessity. If we look at relative performance, the valuation on benchmarks, we think there's risk in it. So in a diversified portfolio of investors and clients, we think there's value in index funds, but differentiation is very important, and investors need to make sure that when they pick managers that do sufficiently different from what they've already got. So if we go onto performance, just I'd like to spend a few minutes to discuss a few things here. Kevin, you've mentioned earlier that we had two distinct periods recently.
Sure.
So what's important here, what we show investors is the first thing is, if one doesn't panic with the market and doesn't run for the hills when it's too late, causing permanent capital loss, one can redeploy capital in bear markets that lead to very, very strong and sustained outperformance after that. The top chart, the blue line is the PSG the long term, and the black line is the benchmark. So when one has periods like the great financial crisis or the .com, the COVID kind of manager is going to get it right all the time, and no manager knows when a crisis has happened, because then it wouldn't be a crisis. But if one in those periods, good decisions with client capital, calm, long-term, and fundamental decisions, and tends to have a period after that where there's significant outperformance without needing to tail or chase the market. And that's all we try to do, given there's a very pregnant and patient and long-term philosophy. There's a 3 periods highlighted in the red box. If we look at the 3-year annualized return after the periods, and what we can see is the negative performance, the good decisions during that have led to significant outperformance. There's that saying, don't ever waste a good crisis. So what we've ensured that when we come out of unknown market crash or unknown and we think what's important to understand, there's no excuse for that. The reason, however, not excuse, but the reason Kevin?
Yeah, I'm here. Sorry, that's fine. So Gustav, sorry, just now I lost you for a few seconds there. So Gustav, I think that if I look at this chart, okay, it speaks about the long-term track record of PSG Equity Fund, who has been running for many years, and there were periods that you highlighted where that you did 4 in terms of like the fund performance or the fund price fell. And I think that's where investors will get uncomfortable. And I think that's where I, as a financial advisor, my job to help the clients understand and then ask them to stay calm and stay invested. And that's where it's really nerve-wracking at that point in time. But it's interesting to see that for example, the recent period where I would say that from 2019 to like the first half of 2020, where the PSG fund has underperformed compared to its peers or against the market. But then subsequent to that, it did recover, and it recovered quite strongly. All right. So this is can you explain to us why is that? What's the reason during that period of time, 2019 to first half of 2020, that PSG underperformed? And then subsequent to that, what's the reason you overperform the market?
Yes. Yeah, it's a very good question. So what happened is during 2020, anticipating a cycle turning, we started thinking that the stimulus pumped into the will lead to what we see right now, inflation that's going to force the Fed and everyone to raise rates. We anticipated that these tech stocks, Gara made the comment earlier, we sold our tech stocks too early, and
right.
One can see in there we rotated out of that into your shorter duration, high dividend yielding stocks and real assets. And we were early in that. We can't time the bottom, and then what happened is we overhit. And the stimulus just went into overdrive, so it made it a lot worse, and everything that we had been expecting, which is happening now, and arguably even in a worse fashion than what we expected it. But all of that were the exact opposite happened. The stimulus ramped up. The US stimulus, I think it was insane amounts, but more than the COVID damage globally. So that caused us to perform even more. So there's no excuse. But the reason for underperformance was that we started putting too early into stocks that would do better from higher inflation and higher rates, as you see. And because we had seen we saw the flags coming then, and we didn't want to kind of miss a change in the cycle, which can be very powerful and long lasting. So what happened when COVID hit is we remain calm and take a long-term view, and what we did was we identified the additional stimulus, something which is going to impact the cycle and could mean that a potential inflection point is even more powerful. So what we did is we bought what we believe are decent assets at incredibly cheap prices and repositioned our portfolios in terms of real assets and shorter duration assets to an even greater extent. And because the prices were a lot lower, we will typically do that. So same quality assets at lower prices. And so far it's worked. Post the COVID crash, we're pleased with what we've delivered for clients. And our key message to clients would be to be careful to assume that this outperformance or the performance of these kinds of assets is done. People often ask us, is it too late now? It performed well over the last few years. It's too late now. And we would point them to first the length of other periods, and also the length of the previous part of the cycle, and then just ask them the question: what if the second leg of the cycle is equally long? Then one must be careful to get out of these assets too quickly. So it was a story of two parts, and obviously we would love to have not had that big drawdown, but it was done for in our view the correct reasons, sticking to our process, sticking to our philosophy, and the outperformance was done because we stuck to our process. We didn't panic, and clients have benefited. So it also speaks to kind of investors and clients of yours and clients of ours that no fund manager is going to perform well all the time, and one must pick your fund manager and your fund based on its characteristics, the process, the philosophy, how it is managed rather than how it performs over the short term. And then stick with it and understand there will be bits of underperformance, but as long as nothing changes in the fund and the philosophy and process, then one must take a long-term view. Equity funds typically are 5 to 10-year funds, 5 minimum, and should be judged as such.
Gustav, that's why I'm putting this caption here, that I think it's investors would do well to stay invested with a good manager through the cycle. And when we talk about cycle, it's not just 6 months or a year, but rather it can be 3 years, 5 years, or even 10 years, etc. So a cycle comes and goes, but it's typically it's a longer period of time, and investors shouldn't just chop and change. And I think that even to the best of my ability as a financial advisor or financial planner to my clients, at times I just can't convince certain clients to stay invested. When they saw that, I think back in 2019, 2020, the height of COVID and the market crash, that there's some clients, they phone me and they send me message and say, Kevin, what's going on here? Like I lost 20% or 30% of my value. I, even though I try to explain to them, this is kind of a market when it's at the down, but rather you should stay invested, or even for clients who's got money, probably you should even invest at probably close to the bottom of the market to stay positioned for recovery. But some clients, they just lost confidence. They lost the faith, and they just say, "No, Kevin, it's not performing. I invested for 2 years, 3 years, and now it's negative return. I'm pulling my money out." So then, unfortunately, then they would have lost out on the recovery subsequent to that. So I think this is a really powerful lesson to all the investors. I think that investors either need to understand and work and invest with a good fund manager like PSG, and work through the cycle, 3 years and 5 years or even longer, and stay invested and don't just chop and change. And if an investor doesn't know who's a good fund manager, then work with a good financial advisor that can put you in good funds or portfolio of good funds. But I would say to all the viewers out there, if you have someone who give you advice to say, you chop and change every 6 months or 3 months, then in terms of your investment or funds, then I think that's probably a very dangerous strategy to follow. So patience, I think is the key in terms of investing.
I think that's such a good point, Kevin, and that's unfortunately why the data proves that often clients underperform the funds that they do invest in, because when the pain is the most at the bottom, they move down to a lower risk fund, or they move into cash until they've got the confidence to come back, and that's typically when you lose out material gains. So I would echo your point. Trust your financial advisor. Stay invested for the long term. It will be cyclical. It will go up and down. But if you've picked the right advisor and the right fund, you will be better off. So,
right.
Just to conclude,
your closing.
There's a bit of repetition here, so I'll just touch on it. We do think that there's a high likelihood that the cycle is changing. We do believe that the next decade could look very different from an inflationary and risk-free rate perspective, and investors need to be cognizant of that rather than just expect the same as the last kind of decade. We believe that our differentiation, our stock picking, our benchmark agnostic approach is very well suited, and this is a very good environment for us. And we're quite excited about the next 10 to 15 years. We think there could be material performance for investors that are willing to be open-minded. And so we would encourage investors to and get with us. We would love to be on this ride, and all our staff internally, we're very excited about where we are. So yeah, I suppose that concludes it. I hope we've been able to add some value to your viewers.
Great. Thanks, Gustav, for your presentation and the points you have raised. And I think that overall, I get a good in terms of the feedback in terms of where PSG is positioning, and I think that from a kind of investment logic point of view, it certainly makes a lot of sense. Gustav, I just have a kind of maybe a comment from one of the discussion I had with an advisor, okay? Because that advisor told me that one of the prospective clients he interacted with, he said that what the client wants is to, help me to switch to last year's winning fund every year, and I think that we as advisors, we have learned to avoid this, but maybe I like to hear your comment about this, because I think that previously, many years ago, I would probably follow this kind of a strategy to say pick last year's winner. And because if he's a winner last year, he's done the best. So surely he will continue to do that going forward. But from your side, why would this be a losing strategy?
Well, yeah, I find that an interesting strategy. It's like backing the football team that won the previous World Cup to win the next one, or to go to a restaurant the night after they had the special every time. Look, it's probably a strategy that's easy to defend or explain.
Yeah.
But as we've just made the point on our funds, and I think data will support the fact that strategy will materially underperform. So I would advise clients to pick a good manager that you can trust, and then not to constantly look at the performance and consider it, and know why they're there and why one's bought the fund, and just stick it out. Going into yesterday's euro constantly, I think one can destroy a lot of accumulated gains, and to me, one needs to trust the fund you're in. This is long-term investing is a long-term game. I remember Buffett was asked why, if his investment philosophy is so simple, then why doesn't everyone just follow it? And he said, because not everyone wants to get rich slowly. So one must remember that this is a long-term, investing is a long-term game.
Yes.
It's not about switching and trying to be too cute. That would be my only advice. Yeah,
that's so Gustav, I just use this slide of yours to illustrate the point. So for example, if someone based on PSG's track record in a time of 2017 and 2018, then PSG was doing well, and then say, okay, now let me switch to PSG fund. And then in 2019, then PSG was actually underperforming. So then they were sold out. They would have sold out, and then say, okay, switch to another fund. And then when PSG was starting to recover, then actually you have lost out on all this recovery and overperformance. Whereas the other fund that investor switch into maybe actually have become a loser. Because I think if we look at the longer term trend, no fund manager could be like a first quartile every quarter, every quarter, and all the time. But rather it would be lumpy, like your chart shows. So it's really important that the investors, they don't just pick last year's winner and then switch every year, because that I think that maybe the result actually will show that over the long term that the investor will lose quite a lot of the investment performance he will be getting if he just stick with a couple or one good funds. So so thanks Gustav for your comments, and I just like to convey my thanks, Gustav, on this Friday to join and to participate and to show us what PSG stands for and where the opportunities are. And I think that for the general public that who knows no wise about picking stocks and all that, rather leave that task to a professional manager like PSG, where you do that all the time. You check the market, you speak to the management, and you do the analysis. And I think that for the general public, rather work with a good fund manager than trying to pick the winner and go with a rather risky asset classes like your Bitcoin. So Gustav, thanks very much. And I'd like to wish all the audience out there well, and enjoy your weekend.
Kevin, thank you. Thank you for the opportunity to appear on your show. Thank you for the support. And thank you to your viewers. Thank you for your time. And I look forward to seeing you again.
All right. Until next time. Bye.